Okay, good afternoon, guys. Welcome to this live trading session for US retail sales. So again, I've done quite a lot of trading live sessions over the last few months. I think it's very important right now that we understand the fundamentals that are driving the markets and also the opportunities that present themselves and allow us to make money. So the live trading session, what we'll do is have a bit of a run through what the figure is, what it means to the market. I'll go through the expectations, what the market, how it's going to anticipate this, and then we'll actually trade the figure live. So again, if you've perhaps seen some of my other live trading webinars, we generally do non-farm payrolls and one of the other sentiment figures every month. I'm generally very, very profitable. I think I'm up 14 out of the last 16 trades. So very, very interesting. And again, I hope you find it enjoyable and something a little bit different today. Okay, now before I start, as always, I need to read the risk warning. Now, spread betting and CFD trading both carry high level risk to your capital with the possibility of losing more than your initial investment. These products might be suitable for all investors and only intended for people of the age of 18. Please ensure you're fully aware of the risk involved and, if necessary, seek independent financial advice. Again, this is educational only. The content of the webinar is the personal opinion of the moderator, not Intertrade.com. The content does not constitute financial, investment, or tax advice. You're advised to discuss your specific requirements with an independent financial advisor prior to entering any bet. Intertrade.com is not responsible for disclaiming all liability for the content of comments during this session. Okay, so when we talk about economic releases, we're generally talking about the two main types. So we have our leading indicators and our lagging indicators. So we talk about leading indicators. Now these offer a preliminary sign of potential up-and-coming change to the business cycle. These are things like consumer expectations, building permits, money supply. Then our lagging indicators, so again, by the very nature of the name, these indicators change the economy as a whole, and you have to wait a little bit of time for the actual magnitude of the movement to filter through into the market. So these are things like your unemployment-related figures and your consumer and producer price index. So obviously today we're going to be looking at the figures for the retail sales. Now, at the same time, we'll have the producer price index being released, the PPI. But again, when I teach all these webinars, we're talking about the effect of fundamental data. We have to understand what the economy, what the traders, or what particular cycle we're in. Okay, 5 years ago, it was all about price stability. Very, very famous phrase that was used by Jean-Claude Trichet. It was all about keeping price stability and controlling inflation. Okay, the economy was strong. There was plenty of money, plenty of jobs being created. Everything was good. So what we wanted to do was make sure that inflation was under control, and we measure inflation by the consumer price index and the producer price index. Now, really, in this particular economic cycle that we're in, we're not as concerned with inflation. Obviously, it is becoming a problem, and we don't want inflation to be too high. However, what we're really looking for is the figures all related about growth, jobs creation. So that's why the non-farm payrolls, the sentiment figures like Philly Fed and GDP are very important. All we're looking for is where the growth is. We're not too concerned about inflation. So what we're going to be trading today is the retail sales, the headline figure, but we will have to be aware that the PPI will be released at the same time. So it always makes it very tricky when we're trading figures, because we have to understand again what's going to be most important to the traders in the market and what's going to move our particular market the most. So again, in my opinion, that'll be retail sales this afternoon, the headline figure. So US retail sales, what's its definition? Well, retail sales measure the total receipts at stores that sell durable and non-durable goods. Okay, so consumer spending accounts for 2/3 of GDP. So again, is a key element in economic growth. So it just goes to show the US economy is still the biggest consuming nation on earth. And we're seeing good sales. Again, it shows people are going out, people are feeling secure in their jobs, people are buying, big durable white goods, etc., and that's stimulating the economy. So why do investors care? Okay, very, very important that we understand again that fundamental information and fundamental trading is very, very key and is an important part of any trader's career. Every trader will look at technicals and will look at levels, trends, etc., but you can't necessarily always be a technical trader. Other influences are affecting the markets. So again, when we have key speakers out of the Eurozone, key speakers out of the Fed, it's very, very important that we understand what these figures mean within the markets and how they manipulate the markets and make them move in a direction. So again, our technicals should tell us where the market should go to, how far it can extend. But then when we're looking at fundamental information, that's the bias, that's what we trade off. Then the fundamentals help us to understand where the markets could go, and then we understand these boundaries by drawing in the technicals. So again, it is important because this particular figure does show us that it's a direct correlation between what's happening in the US and therefore what their business cycle is. So again, if we're looking at more retail sales, we're looking at more people going out buying things. That shows that people are confident in the short-term outlook, and therefore we can use that to understand where the particular markets we're going to trade today could go to. So as always, I'm going to trade in the S&P. This is a US figure. So again, I like to trade the S&P 500 because again, it's directly related to the data. And again, it's something I understand and I like to trade. So again, my track record and my confidence comes from being able to predict how the S&P is going to react to these figures, to understand where it could possibly move and it can extend to. And that's what we need to do and understand when we're trading and we're trading economic data. Everything we do in trading evolves and revolves around confidence. So if you understand your product, you understand how it reacts, how it trades, how it moves, then already you're one step ahead of the competition. Again, a lot of people ask me what's the right figure to trade, and what's the right product to trade for each figure. It all depends on yourself, on what you have experience in. There's no point, I don't think, changing from different contracts constantly. Okay, just like traders have their own systems and their own styles, markets move in their own particular way and have their own idiosyncrasies. So again, it's about understanding where the market could go to, if the market is going to ever be manipulated or pushed in one direction before doing the true move. And once you understand that I've traded the same market for a number of times, this adds to your confidence and adds to your understanding. So again, in my opinion, as always, very important that we have one particular or maybe a couple of markets that we can trade for these figures, that we know we understand inside out, and we know when we hear the figure released, if it is out of line, what the market's going to react and how the market's going to move. So what will happen to the markets? It's quite simple. Strong retail sales are going to be bearish for the bond markets, but favourable for the stock markets. So again, that's why we're trading the S&P today. So a sluggish retail sales could mean that the bonds might rally, a bit of a safe haven. Maybe we'll see a move in gold. But again, it'd be fairly bearish for the stock markets. So remember, it's an inflationary figure. So high inflation is not good for the economy as a whole. So we need to take this into account when trading the stock markets. Okay? So that's why it's released for the PPI, because the producer price index is also a measure of inflation. So before the figure, we'll generally see a tight range. So again, I'll have the chart up in a minute, and we'll be able to look at my trend lines where I think the market could extend to. As you can see, the S&P is in a fairly tight range at the minute. That's because people will be waiting for this figure. So again, it's always good to sit on the sidelines and to wait for this announcement to come out. If the markets aren't moving, then there's no point wasting your bullets or trying to trade when there is no movement. Okay, if the markets are waiting for these big figures, as we know, retail sales is started up on Bloomberg's a red star, so people will be looking at it. I'm not going to say that it's the most important figure that's released this month. It is probably not, but it will be a market mover if it does come out of line. So again, that's something to remember. We don't have to trade every figure. Non-farm payrolls, again, has been out of line for the last 4 non-farms. So that has moved the markets quite significantly. I'm not going to say that retail sales are going to make a big move in the markets today, but if it does come significantly out of line, and remember, I'm looking down all the PPI and retail sales stats here, which I'll run through before the figure comes out, they're all minus generally. So we're looking for, any kind of positive number could, send a positive bid into the stocks. However, we see some big minus figures. There's a lot of room on the downside of the S&P especially. We could see the markets, use this as an excuse to sell off. So again, we can look at the market action before the figure comes out to see if any bias is being formed. We set our levels in and make sure we're set for any outcome. So again, any positive figures we could be looking to buy. Any, extremely negative figures, again, we could see a big sell-off in the stocks. So when we talk about trading any kind of economic release, any kind of figures, there's 3 main techniques anybody can use. Okay, so the first one's taking a position prior to the market releases the figure. The setting orders outside of the current trading range, and then there's trading the aftermath of the event. So there's trading after the figure's released. So taking a position before the figure. So it's fairly simple. This is as expected. You can't really interpret this any other way. If you have a particular bias, maybe you've done some research, maybe you just have a gut feeling, you can position yourself before the market releases this data. So obviously there are problems. We can have volatility just as the data is released. So, again, how do you manage your stops? What do you do if you're wrong in that trade? How quickly do you exit? These are the things you need to think about. So again, there's nothing wrong with trading this way, but there's a reason that a lot of people wait for the figures to be released. Because these figures, by their very nature, are very difficult to understand and to get exactly right. So if other people are waiting for this figure, if it is out of line, if you can trade quick enough, and we can get filled quick enough, we can get on that initial move. That's another thing that I like to show in these particular webinars. There will be more than one opportunity in the next half an hour if the figure is out of line to make money. You don't always necessarily have to get filled. So remember, when there's high volatility and we're trading on a spread betting platform, it is difficult to get filled at market. So what we can do is not beat ourselves up about this and not get annoyed. What we can do is we can trade after the first 3 or 5 minute candle prints, and we can trade off the back of that. So again, this is a technique I use quite often in trading sessions, that I won't try and hit the initial figure. I will wait for the first candle to print 3 or 5 minutes, and then I'll take a view on that. So maybe I'll do a 50% retracement of the first 3 or 5 minute candle and use that as my entry point. These are things, again, these are the techniques we need to look at. If a market does see the figures significantly out of line, it will extend to a point, and this will take time. So there'll be more than one opportunity in the next half an hour of that data being released to make money. So again, these are things we can control. We can't always control getting filled at market the second after the figure's released. What we can control is our entry point 3 or 5 minutes after. So again, it's just another technique that we can use and I can show you consistently works. So number 2 is holding the stick at both ends. So this again is a technique that's used by a lot of traders that I've managed over the years. I myself haven't used this technique that much, I'll be totally honest. I like reacting to the figure, I like to negative and positively average, so I like the control. I'm not particularly interested in trading this way, but again, not to say that it isn't a very good technique, and traders over the years have made a lot of money. So all you're doing with this is you're going to trade any outcome by placing open to limit orders in and outside the range. So again, if you think the market's going to spike up, then we're looking to put levels on the upside, and you're looking again, you have to think of this particular style of like an elastic band. So you're looking to pull the elastic band to hit the extremes on the highs of the market or the lows of the market and get filled. Then the market is going to snap back quickly to fair value, and this is where you take your profits. So again, it's just another way of stacking up the order book and allowing for any kind of quick directional moves to get filled in the extremes and take a quick profit. So again, it's something that we can adopt and we can trade around. This is just an example of how we can see our particular levels in, and then we see the market moves quickly up and down. It's very, very difficult if you're just going to trade the aftermath to get these extremes of the market. So again, we'll just be looking for any points, any peaks on the top or the bottom to get filled at before these long candles retrace. So again, that's not a great example, to be honest. So then there's trading the aftermath. Now this is what I call real trading. Throughout my 10 years of trading, this is what I've done. I've always waited for the figure. So again, being a professional trader in the city, etc., you pay a lot of money to have direct market access. So when I do press the button, I'll generally get filled at market. However, we're all generally going to be trading off a spread betting platform this afternoon. So will I. So we have to find out other techniques and other ways of maximizing our entry point. And again, just from my personal experience, that if the figure is out of line, generally a 3 or 5 minute retracement on the first initial candle is the best way to trade. But it's not to say we can't try and hit the figure. Again, what we'll do is we'll set up our screens before we trade, have our specific limits and products we want to trade on, and we'll hover over the buy or the sell. And when the figure comes out, I'll be listening to it on the squawk. So I'll give you my initial understanding of the figure. So again, if I'll be trading the S&P, so if I think it's a strong retail sales, I'll say buy. and I think it's a weak retail sales, again, that'll be a big sell. And again, what we'll try and do is judge and engage where the market's going to go. And again, what we could do is find the figures fairly in line, and we don't trade. This is probably just as important in trading, that when figures are in line and they are in with expectations, that we don't just jump in. There might not be an opportunity that presents itself. So again, I would say that any kind of inline figures are seen as good news at the minute for the markets, because there has been quite a lot of negativity. But it's not to say that'll push the markets up considerably. So what we might have to do is sit on our hands. So if it is, we can watch the market for the first 15 minutes, but if we don't see some direction come into the market, or we don't see a particular bias, then maybe we have to sit on our hands and say, okay, this isn't a good trading opportunity. Let's wait for, I don't know, the next economic piece of data, the next speaker, or maybe just the next technical opportunity to present itself. So very, very important. We don't have to trade every single figure. And even though we've waited, and obviously I do want to trade, and I do want to, to make money on this particular webinar. But if it isn't out of line, and I don't see an opportunity, then I will tell you I don't. There's absolutely no point trying to force the market, even in these situations. If the opportunity doesn't present itself, then it's just as important in trading that we take a step back and that we sit on our hands and we don't just waste money or get in trades without any real conviction. Okay, so we've got about 14 minutes before the figure's going to be released, so we can take some questions. Any thoughts anyone might have on what the figure's going to come out? You guys can tell me what you think. Okay, sometimes lately the markets ignore bad numbers and go up. Yes, exactly right. Because again, when we see really bad figures, a lot of people use that to say that there's going to be another call for this fabled quantitative easing. So every time we have a really, really bad non-farm payrolls, well, the government's going to have to step in, put some more money to, stimulate the economy, etc., etc. Well, that is fine, but again, as traders and, as budding economists, we all know that we can't just keep printing money. Okay, it's not sustainable, and it's not a responsible way to keep stimulating the economy by printing more money. It just is, again, it's a short-term fix. Trying to address a long-term problem. So again, these are the things we need to think about. And that's why I said, I picked retail sales, because it isn't something I've traded very often, but it isn't to say that it won't be an opportunity. So again, like I said, we will have the added complication of PPI being released at the same time. But again, if this is significantly out of line to the upside or downside, we will see market moves. So again, guys, if you've got any questions, any thoughts, is this a figure you've traded before? Again, we've got some good comments from Harley and Boogie again, that, the markets do act in weird ways. Yeah, okay, I don't quite understand the question. Why do spreads widen then? I don't know what you mean with that. Spreads widen because, different products have different spreads for a start, but, the spreads widen because of impending volatility. But again, what we're looking at right now is how the markets are going to react to specific data being released. So markets will go up or down accordingly. We might see false moves. We might see the markets move, as we've just said, in the opposite direction before they come back. But that's because, again, maybe people have taken large positions, preempted the market and have to get out. Maybe the market's been manipulated or pushed on low volatility, low volumes. We don't know. That's the whole point I'm trying to make by these things. We can't control the market. All we can control is what we do. So if the market does move in a way that we don't expect it to, anticipate it to, then that's good for us. As long as we're not too quick into that position. If we see a terrible retail sales and the market pushes up 50 ticks in a straight line, then we know that there's going to be people in trouble and stops getting set off. So we can sell at a better price, expecting the probable trade for the market to come down. So these are things we need to look at and be patient for. It's not always about fastest finger first. Okay? The days of, seeing that the data's out of line, being the first one in and riding the initial move, are long gone. There's too many computer systems, there's too many traders, there's too many different factors affecting how the markets move. But it doesn't say, or it doesn't mean to say, there's not more than one opportunity for us to make money once these figures come out. So again, hopefully, we will see an out-of-line figure, and if we don't get filled or don't think the initial move is where we should be in, then I'll show you how to trade off the initial full printed 3 or 5 minute candle, and we'll trade accordingly. So again, it's all these things I've done, many, many times before, so it's nothing new. So again, it's all about keeping our calm, being controlled, sticking to our rules, not jumping into the figure if we don't feel that conviction. These are all the important things we need to learn as a trader. And it's all about having that discipline. And it's all about having that, again, that belief in what we're doing is right, that we understand our markets, we understand what the data means to the market, and then trading accordingly. Okay, how do I manage my stops? Okay, well, unfortunately, the way I teach sometimes is not always the way I trade. So I have a fairly large account, so I'd like to trade relatively small size and build into positions. So that gives me the flexibility to negatively average if the trade goes against me, or to positively average. I would generally set a stop as a finite amount. I will not physically put a stop in the market. So it's not to say that's the best way to trade. I would generally advise a lot of traders or many traders to put stops in so they know where their out is. I will just put a finite amount on my trade. So if I'm trading a certain size, maybe £5 a pip, I will put a stop of 250 or 300 pounds downside to that trade. So I can manage that. I have the discipline, I have the big account, and I understand trading enough to be able to trade that way. Okay, so you can't play news trade really anymore, just wing it, wait and see. Again, I mean, it depends. If you had some bad experiences trading news before and you have got burned, so you got caught on a move that you thought you understood and you didn't, it's very difficult to have the confidence and to keep trading figures. Figures are not easy, and that's why I say that you should try and keep the figures you trade to a minimum. So maybe, watch every figure to trade, and then, pick 2 or 3 like non-farm payrolls, maybe a sentiment figure, a GDP figure, and pick something you consistently make money with. Okay, well, spreads widen around news and data releases because it's an unknown quantity. It's new news coming into the market. Okay, people are waiting to see these figures and to see the effect. So it's an unknown quantity. That's why they widen. Yeah, absolutely. Markets act so impulsively and do reverse very, very quickly. And that's another factor of people in the market. Okay, so there'll be people, there'll be computer systems taking quick profits. So like the markets will come back to you, perhaps, reverse against you. And that's what we have to filter out that noise. So that will generally happen in the first 5 or 10 minutes of the data being released. Then if the figure is out of line, we will see a particular direction coming to the market, and that's when we need to be involved. That's why I keep saying it's not always about the fastest finger first and being in the initial trade. Sometimes that can be more dangerous than sitting and waiting for the market to form an opinion and trade accordingly. So again, it's just about adapting to the market conditions. If you don't want to be on that first 10, 15, 20 tick move that's very volatile, then we don't have to be. The market is still going to move where the market's going to go in the next half an hour. So why don't we let the people, the computer systems, the other traders fight for them 20 ticks? And once the market's moved 100 ticks in one direction, then we take as much of that as we can. So that's, again, that's the things I'm trying to teach today. It's all about having that restraint, that control. But yeah, great question, guys. I'm glad you've had these experiences. Hopefully, by watching me today, then we're going to understand a bit better that there are many different ways and techniques to trade economic data and also be profitable. Okay, guys. Well, I just need to go and put the charts up now. So I'll just put that on your screens. Okay. So this is an example of my charts. As we can see, we're in a fairly tight range between 1325.9 and 1321.4 in the S&P. So again, I've got a very simple chart, just got some RSI, and I've got Bollinger Bands that kind of show the extremes. I've got some levels in. So again, what I do is I'll look generally at the hourlies. So that's how the market looks in the hourlies. Okay, so we see some good support down here, around 1311.4. The market's trying to push up to round about 1350.4. Okay, the chart screen is blank. You can't see that, guys. Okay. Let me try this again. Okay, guys, if you just let me know if you're seeing that chart, you should be seeing an hourly of the S&P. Brilliant. Thanks for that. Brilliant. Thank you. Excellent. Cheers, guys. So again, this is what's showing where the market could move to on the high side and the low side. So I generally start with the dailies, drawing some big levels of where the market could move to, move down to our hourlies. Now, generally, when I'm trading, I'll look at 15 minutes. But for figures, as I said, this is what a 15-minute chart looks like. So again, we've seen quite the gap up obviously from the Spain bailout that was announced a few days back. Markets didn't react very kindly to that, sold all the way down to our levels of support down here at 1306, round about there, and then the market started to recover. So we're really in the middle of this range. So again, if we did the Fibonacci retracement from the top to the bottom of this move, we're round about at 50%, trading back to where the that whole move was. So again, this is just a rolling S&P daily on Intertrader. So it's not the futures. It should just be the cash price. So again, we're at 50% of the move. So we're showing that the market could go higher on a good figure, could go lower down to here on a bad figure. But like I said, what we're going to trade is off the first 3 or 5 minute candles, because that's where we're going to get the most information out. So let's just zoom in here. So again, we can see that where we're trading now, we're just breaking through to our low end of this range here. So maybe the market's expecting a negative figure. Again, we don't know. We shouldn't preempt it. So perhaps just zoom out a little bit to make it a bit easier. Zooming over a wider time period. Okay, so what we'll do is I'll zoom in to the first 3 or 5 minute candle once the figure's released and tell you where we're going to get in. So one of the bigger, broader schemes, what I'd say is that if we do start to break to the high side, we're going to be looking for a move up round about 1325.9. On the low side, poof, again, once we break through these levels here, there's nothing down to 1318, I would say, and all the way down to 1311.4. A lot of room on the S&P for the downside. So no, this isn't really scalping. This is just trading news information. We can take a small term trade into a longer term position. Again, it depends on what the figure is. All right, guys, so I'm just going to turn the Squawk on now, because that's what I'm going to trade off. So there'll be a rundown from the Squawk system that's on Intertrader, and this will tell me what the figure's being released at. Okay, and I will then pass this on to you. I'll just do a rundown for the figures in the next kind of couple of minutes, so we all know what exactly to expect. Okay, so just give me a couple of seconds, guys, while I just sort this out. Okay, that's not done. So what I generally do is I'll wait for the guys to do the rundown on the Squawk system and tell me. But again, I have obviously do my own research. It's very prudent we all understand what the figure's expected at, what the data is going to be released at, and what we're going to trade off. Okay, so again, I'll do a quick rundown now. The PPI is expected at minus 0.6 with a range on the downside of minus 1.2 to 0.2, minus that is, on the upside. The X-Autos is expected at 0.2, the only positive figure we have this afternoon, and on the downside 0.1%, on the plus side 0.3. So the retail sales, the headline figure, which I'll be saying out loud and trading off, saying buy or sell, is expected again, minus 0.2, fairly wide range at the minute of minus 0.7 on the downside to 0.1 positive on the upside. Then we have the retail sales less autos, expected this afternoon at minus 0.1, minus 0.4 on the downside, and a positive 0.2 on the upside. So again, quite a few figures being released at the same time. The headline figure is what I will be trading off, and that's retail sales headline figure minus 0.2. On the low side, minus 0.7, 0.1 positive. Okay, so we've got a minute to the figure, guys. So I've our screen set up. Okay, guys, so I've got my trading screen up now. I've got my size in. So I know what I'm going to be trading today, what size. So we've got 30 seconds to the figure now. Again, I'm going off headline figure, which is minus 0.2. So again, I'll be saying buy on a strong figure, sell on a negative figure. Okay, minus 0.2 inside, in line with expectations. Okay, guys, so slightly worse than expected figures, to be honest. The main retail sales were in line, but the PPIs were a little bit more out of line. Let's go and look at the 5 minute candles. So again, let's put it on the 3 minute, actually. Okay, so we see, again, the markets have reacted fairly badly and sold off quite quickly. But again, the markets sold off very, very quickly. So again, if we're working orders, then again, people are taking quick profits. So the markets have reacted, especially the S&P, slightly negatively to this particular piece of information. So again, we're seeing a fairly again, the markets have pushed off on the back of inline data, to be honest. Although the PPI was a little bit worse than expected, the core retail sales and less autos are absolutely in line with expectations. So again, we're just seeing the markets react in a positive manner. So okay, the PPI, has dropped, but again, I don't know. I don't personally see that as terrible data, to be honest. I see that as, again, with the rest of the retail sales being fairly in line. So let's see how the market reacts. Again, let's get the 3-minute candle here. If this, again, just my personal opinion, we might see the market sell down slightly and then look to recover. So again, let's zoom in on our levels and see where the market could possibly extend to. So again, we've broken through the 131.9 level that we have in place. So again, we'll wait for this 3-minute particular candle to print and see where the next candle opens. So again, if we see the next candle open towards the low side of this initial 3-minute print, then we could see a continued selling off. If we open up towards the middle, we could see the markets recover and look to head back to, especially the low end of the Bollinger Band at 1320.4, or even move higher to the moving average of 1322.6. So again, that's, again, we have to keep, again, as you guys are saying, keep an eye on the other correlating products, but then also, understand the data that's come out. Although the rest of the figures, the retail that we're looking at, were in line. The PPR was a little bit lower than expected, but again, I don't see this as negative data. Okay, so the first 3-minute candle is printed now. So again, we've opened to the low side of it. So we're going to look to probably test the 1318.6, the low of that previous. If we don't, then again, let's see if we recover back into our previous level of 1319.9. If we start to recover strongly, I could see this market move back up to 1322.6. So again, we've not got an initial move because, again, although the market did sell off, when the next candle did open, we're not seeing a continuation just yet. So maybe this is positioned now in the S&P to look for a bit of recovery. So again, I would look for this 3-minute to hopefully, before we do trade, close above 1319.9 and then see the market recover to try and get to 1322.6. Okay, Harley's just saying the decline in PPI is the largest since 2009. So that's good information. Cheers for that, Harley. So again, we have to understand what this means for the market. So okay, the decline in PPI is easing off in inflation, but obviously the producer price index, declining is a negative figure. So it's how the markets are going to view this. Okay, so it's bad data on one hand, but inflationary is not so bad for the other. So it's what we think. So that's, again, what we have to understand. We have to understand what the market's going to react to this, what other traders are thinking. Are we just thinking this is good for him, slightly better for inflation, so a longer term is better for the economy? Or again, we've seen yet another negative figure out of the US, poor producer price indexes, showing, again, weakness into the US economy. Is this called quantitative easing, or is this just another long line of poor figures that are coming out of the US? So again, okay, we're seeing a slight retracement. So again, although this isn't a great big candle, we could do a Fibonacci retracement on this initial move. So let's just see what the initial candle tells us. Okay. Zoom in. Okay, so that tells us that yes, we're hitting right back to 50% of the initial move. Like I said, when we're talking about Fibonacci retracements, it's something that always, or not always, okay, very, very regularly works. So we've seen this initial Fibonacci move that we've moved down from here, okay, 1321.1, the high of the bar, candle, sorry, to 1381.6, the low, and we're already 5 minutes after the data's released, we're 50% back to the retracement point of that initial 3-minute candle. So again, this thing's worked time and time again. So okay, so we're at 50%. What's the likelihood is? Well, the likelihood is that we're going to continue, I would say, if the market doesn't see this as such bad data, to retrace at least 100% of the initial move, or if the market is going to take this as negative data, we see the bottom, okay, once 50% has been retraced and hit, hasn't been sustained in any buying action, we look to hit the bottom, 1319.4, of the 3-minute initial move, and then the market's going to move lower and try and test the low. So again, we're seeing another green 3-minute candle now being printed. So again, if we close above the 50% for this 3 minutes, that may indicate some good buying signals. We've got our target in place already of 1322.6, and that's right slap bang on where the moving average is, of our 50-day moving average. So again, these are things we need to look at now. Again, in my opinion, I'm not probably going to trade until this closes, but this could be a good position to buy the S&P, because if we close above the 50% retracement, we know where the likelihood is we're going to test. We're going to test 1321.6 and then hit 1322.6. There we go. The market's already moving higher. So again, by not getting involved in the initial move, okay, waiting for the next 3-minute candle to print, we're looking at our bias, and once we start to push above the 50% retracement, the next logical place to go is 100% retracement. Okay, 1321.1 to be tested. Previous highs of these particular candles, again, we've got a nice doji here. The market's not made its mind up. So 1321.4. We break that, then it's up to 1322.6. Then who knows? So again, this is just a different way of trading the figures and being able to make money without necessarily getting involved in the initial move. So we don't need to panic. And again, that initial 3 minutes gives you the understanding of the markets. So again, as Harley rightly said, 2009, some of the worst PPIs, for a considerable amount of time. But now the market's saying, well, that's not particularly bad. It's good for inflation. The rest of the retail sales are in line. The market's moving back up. So again, it's no coincidence that the lines and levels I'm putting in the S&P are being hit. We've already touched 1321.4. Okay, so it's all self-fulfilling. Okay, it's not saying that I'm, a trading genius or anything. I'm just saying what the likelihood is. So will the markets now test, as I've said before, 1321.6? Yes, they're doing it now. And if they break through that, the likelihood is we're going to see 1322.6 being hit. So again, all these things, how we trade the markets, how we trade this information. So on the first glance and the first few seconds that data's come out, people will be scrambling to sell. But actually, the majority of the figures that we were looking at, the retail sales, were in line. Okay? So in line these days is good. Even though the negative, in line is good for the market. So everybody that was getting short has got squeezed out. The overall market sentiment is this is actually not as bad as data as we think. So we've waited for the 3-minute print after the initial move, did a simple Fibonacci retracement. Once we get above that 50% mark, the likelihood is we're going to see 100%. And if we don't see 1322.6 being hit, then, well, at least if we've got in at the 50% retracement mark, that's still good profits that's been made. So again, we might see the market's range, we might see a bit of profit taking, but again, we've already now, hopefully, locked in some good profits. So again, it's just different ways, different techniques of trading these figures. We don't always have to be, in the initial bit of volatility, the initial bit of, the move. Again, if these figures are even in line or out of line, there's different opportunities and different ways of interacting with the market. So again, if the market does sell off and do see some profit taking, where are we going to stop? Well, I would suggest that the market could sell back down to 1321, spot 1. Okay, that would be the top of that initial move. Then, again, if we're still long, maybe we want to buy some more at that point if we still think the market's going to continue to move higher. Okay? So we know our targets. If we break through 1322.6, again, the market could break through the moving average. I don't see any great resistance past 1323.4. So again, the next realistic target would be 1324.5, which is an hourly level, the top of the Bollinger Band. So again, this is where we already need to be involved in the market. Everyone else is scrabbling to get long now is going to have to put up with a certain degree of pain. If we're long from the 50% retracement of the initial move, then we've got loads of room to play with. Not to say that the markets won't come back to here, as I said, to probably test the high of the initial move. But again, if we're long, and the market does come back to that point, we can either take out some profit there because we're already on side, or look to build more in. So that's positively averaging. So we're already on side, we're letting the profiteers take the profit out from their longs, but then we're understanding the market still probably has some more room on the high side. So okay, we're at 1321.1 now. So again, if we break through with any real conviction, maybe the market sentiment's changing and we need to take out our profit. But if we start to see support and the market starts to close above 1321 spot 1, I would suggest if we're already long, buying more, because the likelihood is that the market is going to push back up and hit our levels on the high side. Okay, guys, so any questions and any thoughts? Do you understand my logic and my thinking behind how we've attacked the markets and traded this particular figure? Have any of you guys made money? Has this been a different way of looking at it? So again, if we close below 1321 spot 1, the next again target could be, as we said, 1319, which is our 50% retracement, and again, could be another opportunity to get long again, or again, maybe we just want to take some profit and wait for the markets, to tell us what it wants to do. Remember, we're only looking at 3-minute candles. Okay, so on the next 3-minute candle, we're opening just below, the high of the initial move. So again, we're going to have to see what the market thinks, what the market's going to do from this point. It could quite easily test the low of the previous 3 minutes and close this gap down here to our 50%. So maybe, again, if you want to hold on to your position, we look to get long again if we hit the 50% retracement, or maybe we just take out some profit. This is the thing as a trader that makes it really, really difficult. So what I do now is that we're either already in the move now, we've decided that if we're long, we're going to stick with the long, because that, as we see with good inline data, is probably a positive thing for the economy, or we just quickly take out some profit. We've been in the trade for 9 minutes now, so it's time to take some profit, look for the next opportunity. Let's look at the chart on a 15 minute, okay? Because all the charts always look different on the different timescales. So when we look at on the 15 minute, okay, we can see we've still got our Fibonacci retracement on the initial 3 minutes, but that's just showing great indecision. Okay, we're finding some good support in the 15 minutes around 1320 spot 9. So again, if we start to close above that point, we could see that, the markets may move sideways, but then, go back up. But again, we're seeing almost a doji being formed, that there's no decision in the markets. We've tried to hit lower. We've had no sustained selling action in this 15-minute candle, but also, we've tried to move higher, touch the previous 15-minute high of that red candle, but then again, not made higher highs. So we have a lot of indecision to be made, or some actual, should I say, even decisions to be made from this 15-minute candle. It's not really telling us anything. Okay, so again, we're trading back towards the 15% retracement of the initial move. So this is what we need to understand. If we start closing below the 50% retracement, then there will be more scopes out of the downside to be tested. And as I said, there is a lot of downside on the S&P that is to be tested. Or if the market starts to find support around this 50%, maybe it's another opportunity to get back long, okay, and to find some support in the market, and the market will move up. So again, we've only really had 15 minutes of trading after this figure. There will be more opportunities now between now and the next hour for the market to move in one particular direction. So it may move up, it may move down, it might move sideways. You have to understand what your particular bias is now. So again, if you're long from the bottom of this particular 15-minute candle, then maybe it's right to stay long for another 15 or maybe the next 45 minutes. Let 3 more candles print. Okay, but it all depends on your interpretation of what you think of the figures. Remember, what we were looking at today is the retail sales. So the PPI, was low, the lowest since 2009. However, the retail sales less auto, was pretty much in line with expectations. So in line in the current market thinking and the way the markets are expecting figures to move currently is good. In line is good. Okay, so like I said, guys, I didn't say there was a particular emphasis to buy or particular emphasis to sell. As I said to you, that the figures were exactly in line for what I was looking at. So that's why I didn't trade. Okay, not to say there aren't more opportunities to buy, there aren't more opportunities to sell. Of course there are. There is always volatility after the figure. But, there was no particular bias. I wasn't going off the PPI, I was going off the core. So again, what we did is let the market sell off. We did an intelligent Fibonacci retracement of the previous initial 3-minute move. Simple. Then we looked to get long and hit our upside levels. So the market now has reversed and we're looking again to test the lows of the S&P. So again, the 1319 spot 1 is where we're looking to test. So again, we could see some downwards movement come back into the market. And again, we know our levels on the downside are quite well spread. So if we do see a negative force come into the market, then again, all the longs will get pushed out and the market could move back. But again, what we need to do now is we're looking at the 15-minute candles, is wait for the next 15 minutes to print. So if we're not in a trade now, we're not long or short, we don't have a bias, let's see where this particular 15-minute closes, where the next one opens. Maybe that's the bottom of the move. Again, we've seen 4, big bodies of red selling candles. Maybe that then signals the end of the move. Or again, this is where we look at our candlestick patterns. So let's look at longer time frames. Again, we can't really go too long on the time frames because we're trading initially off 3-minute candles. So the 3-minute candles are reacting to this new news in the information. It will only affect the market for the next hour or so. There's no point going onto 2 wider time frames. That's why we're trading off the 3 minutes. So yes, then you have to look to take quick profits out when you're trading off short time frames, or then turn that entry point into a longer term trade and then trade off your 15-minute or your 30-minute candles. So again, there are no right or wrong ways to trade this here. I'm just showing you different alternatives. We could have taken 15, 20 ticks on the downside, 15, 20 ticks profit on the upside, with minimal risk. That's what I'm showing you can do here, that you don't have to be involved on the initial move. So we're looking at the 30-minute candles. Let's see what that chart looks like. Okay, well we see, again, we've opened below the previous red hourly candle, which is very, very bearish. And again, we're starting to print a big body. So again, when we see when the next hourly opens, we could see, maybe this is showing us that, the actual sentiment of the market is bearish, is negative. But again, if we're looking at the 3 minutes, it might show us a slightly different picture. Okay, so 3 minutes we're printing off. Okay, so our initial move again was pushed right back up and over 100% retraced, probably 50% more if we did a Fibonacci on the whole move there. Then again, we see a negative candle come in, selling, selling, selling. We try and hit and break through the low of the initial move, which we do, but we find some support and actually close around about that level. It's in the next 3-minute open. So again, we could see the markets range back and look to hit 139 spot 1. Again, our 50% retracement. If we close above that, the markets could even move sideways, or again, I would look to move back up to 1322 spot 6. So again, just different techniques, guys. Again, although the markets did move quite, well, not quite a lot, they did actually move, but that they moved within inline figures. And again, there may be a reaction to the revisions, there may be a slight reaction to the PPI figures, but we're going off the core figures of the retail sales and less autos, which were exactly in line with the momentum of the market. So again, this could be where we sit in our hands and we let the market form an opinion. Or again, if you've still got a bullish bias to this, then we can buy all the way down at this particular point. We can buy anywhere above 1318 spot 6 and expect the market to move sideways or upwards over the next maybe 3 or 4 15-minute candle prints. So look for the next 4 15-minute candles to make up the next hourly bar. Again, we're seeing 3 solid sell-off candles in the 3 minutes, but as we look to the 15, okay, that was the 4th large red candle. Again, in all these particular candlestick formations, as they build up, you will not just see red, 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 red. At some point, you'll see some indecision and the market move back. So maybe 1381 is the low of where the market can be pushed right now, and we're going to see some relief to the upside. Again, if we start to close below this point and break below the initial move, then again, we're going to sell off further. But again, that's your decision, guys. That's what you have to interpret now. We're 20 minutes after the figure now, so all that's been ingested. So you have to understand if that's the bottom of this move, the market's going to move higher, or the market's going to interpret this data as not being as encouraging or strong as we thought. And the markets from this point will pick a new direction and move further lower. Okay, yes, I was 4 ticks per point on the S&P trade, but again, like I said, I didn't actually press the button to trade because I didn't believe that was, a particular bias to sell. And again, I was just telling you my opinions on my live commentary. So again, if we'd have bought, then it would have been good profits. Yeah, round numbers are always good to trade, but it doesn't really matter. As long as figures come out of line, okay, and are not what the market's expecting, the good places to trade. If they do come in line, okay, then again, you have to take your own view on that. If they come in line, then that information is generally already priced in. It's only when figures are out of line that the markets react in a particular bullish or bearish way. So again, now I say we've seen our 3 red candles printed. We've seen some indecision and a close above 1381 spot 6 in the 3-minute chart. So again, what I would expect to see, if we do we expect to see a bullish or sideways move in the S&P now? We're going to hit 1319 spot 9, and then again, there's absolutely no real resistance I can see till the top of these bars, the candles, sorry, at 1322 spot 1. So again, it's down to you guys. It's down to you. Okay, Philip. I mean, does the S&P tick 4 times every 1 point like the S&P? It depends what platform you're using, Philip. To be honest, it should just move one tick each way. But then, whatever I put on, whatever size, it'll be 4 times. That's I'm staking 4 times that per movement. So yeah, I'll generally trade anywhere between 4 and 10 lots. So when each time the market moves 1 increment, that'll be times by my stake. Yeah, I mean, again, in trading terms, people can call them a pip or a tick. That's 1 increment of movement. A point in trading terms is generally 100 pip or ticks. That's the trading terminology I'm used to. So again, people have their own terminology and can say it in different ways. Yes, that's right, Philip, yeah. All right, guys. Well, any thoughts, any comments on that? Again, I've traded at least 2 live figures a month in InterTrader. Again, I generally make money. Sometimes I don't trade, guys. I'm not going to lie to you. Then figures were in line, and I did say to you beforehand, if it was in line and I didn't have a particular bias, I wouldn't trade. So I'm not giving you financial advice. I'm not telling you that you should trade or not. If I thought the figure was out of line, you would have heard me say buy or sell. I would have given you that extra bit of confidence because I would have bought and sold at that initial move. Okay? So again, what we've done is we've learned a different technique today. Just again, we could have made money on the upside. Yeah, then we could have, made money on the downside. So one initial move, with the initial sell-off, if we didn't get filled on that, we looked to buy above the 50% retracement, could have made money. Once the market stopped and we started to see it reverse, our next target was again the 50% retracement. We didn't close below that 50% retracement, so I wasn't expecting the market to move down. Then we moved down lower, broke a lower low, which is towards the lower end of the Bollinger Band. Then the market started to slightly recover. It's going to hit 1319, spot 9, like I said. And then for me, there's quite a lot of upside here until we hit the moving average at 1321, spot 9. Okay, Philip, is S&P easier to range trade than trend trade generally? Lots of false breakouts. Again, that's it. You have to understand how this market moves. And I understand how the S&P moves. So yeah, we can get false moves. And the markets can go in the opposite direction before they form an opinion and go with the overall trend. But again, it's all about making money. So we're trying to make money off this data for one. Then we're trying to make money on people being right or people being wrong. So again, we can be buying when the rest of the market's selling. It doesn't matter as long as we've got defined levels and an understanding where the market could move to. So the market didn't move quite as high as 1322 spot 6 as I expected, but we weren't far off. And then when the market rejected that and moved lower, it sold off downwards to, all the way down to the low end of our 50% retracement and to the bottom of the initial move. So again, it's just a logical way of trading. So in them 3 minutes, there's plenty of opportunities to buy and make money, to sell and make money. Remember, as I said, these figures, the retail figures, were bang in line. So I didn't have a particular bias to do. But it doesn't mean we can't make money. But again, if I don't believe in it, and I can only tell you by being restrained and not trading inline figures, I'm keeping my discipline. It's not to say I can't identify what the market might do. Again, I'm not giving you financial advice. I'm not telling you how to trade. I'm just telling you, as a trader, how I see the markets, the charts building up, and what is possible. And what I say happened. Okay, and again, it's no coincidence that, the levels we have in from previous hourly and 15-minute candlestick formations are being hit. That's self-fulfilling. That's how the market moves and works. It looks to hit points of attraction. So again, as long as we're looking at them, see, we're hitting 1319 19 spot 9 just now. So is the market going to close and break above that and go all the way up? I don't know. But if it rejects that, then that's our 50% retracement again. We could see the market move lower, hit 1318 spot 6, then there's plenty of room on the downside. Okay, guys. Well, I mean, that's a lot of information as always to take in. And again, I'm not saying that, I'm a trading guru or I'm always right. I'm certainly not. But the way I look at the charts and the way I build them up are just from absolutely years and years and years of staring at charts and understanding. So hopefully we've made some money. If we've not, hopefully we've used we've found a new tool of how to look at trades and not necessarily beat ourselves up or get hung up about not getting on the back of the initial move and understanding that, once that 3 minutes candle is printed, that gives us just as much information and emphasis to trade as the initial move does. Okay? So again, different techniques. It works better when a figure is out of line, to be honest. These figures are in line, but again, it's another example of how to make money in trading and how important all this fundamental data is and how important it is to be interpreted by the markets and other traders. All right, guys. Any other questions, please send them through. We've only got a couple of minutes now. If you need to contact me, you can just Google Trader Maker. That's me. I will be doing 2 live trading sessions a month, as I always do. And there's always webinars on FX Street, so you'll always be able to find me if you've got any questions. And again, this one particular webinar has been recorded, so if you want to re-go over it and understand exactly the points I was trying to make by trading off the 3-minute retracement, that'd be great. Yes, generally 50% is the pivot for this method, or the initial 3 or 5 minute candle. If it's a small move, go for the 3 minute. If it's a bigger move, go for the 5 minute, because that gives you more information to go off. So 3 or 5 minute initial retracement to 50%, and that's either a continuation if we close above, or reversal if we close below, that the market's going to go in the opposite direction. So again, just another technique you can use, and you can use the Fibonacci retracement on any single candle that has a big body, okay? And you can use that for your entry point or your exit point, depending on how you're going to trade. So again, use it, guys, and let me know. Send me an email if it works for you. If it doesn't, then we'll try a different scenario or technique next time. All right, guys, well, there's only 2 minutes left now. So again, if you do want to send me an email, just Google Trader Maker. You'll be able to find me. And I hope you've enjoyed it today. And I hope to see you guys in the future. All right, let's say thanks to Maud and Vicky and the guys for looking after me. It's been a great session as always, and I'll send you all a round of email to your email addresses after this, just to fill you in with any more events that might be of interest to you. All right, guys, it's been an absolute pleasure, and I will speak to you all very soon. Okay, guys, cheers.